Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. Beans in the teens? No. Yes. No. Yes. Oh. It moves either side of 13 cents, so it is and isn't all at the same time. However, the move below 13 even is still being mulled over. All attempts over the last 3 weeks to either drop below 12.60 or over 13.20 have failed again. We've basically gone sideways during that time and right now as well. So going back a bit, I said 8 weeks ago here how I'd noticed two new possible patterns, not necessarily complementary. The first was a mid-June to mid-August ascending triangle. The flat topside trend line was capped by the resistance at 14.59, whilst the broken rising mid-June today uptrend, currently at 14.14, is the lower trend line. I also speculate that the rising long moving average, currently 13.90, may have been a dynamic contender for the same rising uptrend, or at least an influence. And what is the now declining medium moving average, currently 13.79, may have been back then a dynamic contender for the flat topside trend line, or again as an influence. Anyway, by late August the market broke down through both the long moving average and the lower trend line. It is at this point that I'd like to mention once more the second related pattern which I'd seen, the bearish halfway hesitation. That takes the action from early to mid-June, making the left flagpole. Now, the market has in reality made not just a bit of a mess, it has made a real mess of the right hand side flagpole for this pattern. Probably a large part of this has been due to the clash with the ascending triangle pattern. Nevertheless, prices had moved lower down through the lows of June and back in late August, reaching the old target X, again in the 1290 area. This was the original primary target for the ascending triangle, and this is where we've been held these past 4 weeks. So what's next? Well, originally it seemed reasonable to look to the downside, so below. We've had a few weeks now to key potential targets, target X1 for the secondary target for the ascending triangle in the 1202 area, and target X2, the first possible ragged bear flag target in the 1178 area. The problem, apart from the lack of follow through lower or a rejection back up, is what we have in between current levels and the two targets. We have two key 50% Fibonacci support lines below, one for the April 2020 to May 2021 move at 1243, and the other for the 2019 to May 2021 move at 1229. These two 50% Fibonacci lines are quite new, only finalized back in May this year, but they are still there. Nevertheless, there are seemingly limited supports available until the 1140s. As for the topside, well, the declining short stroke medium moving average, currently at 1325, is the first obvious choice and is coming fast into the frame of the market. However, I suspect the long moving average, currently 1390, especially as it crossed, though not a golden cross or a dead cross, especially as it crossed over with the declining medium moving average, currently 1379, and it seems reasonable to look to this medium moving average now as the next topside resistance. Okay, so I would normally leave it there, except I had back in early September a short and very interesting conversation with Andre Sheckman in Brazil, a very good friend of mine and also a technical analyst. He asked me to look at the whole of 2021 here as a possible head and shoulders top. And I have to say what he asked does indeed have merit. I will continue to ponder upon this further as the action does not have as clear a neckline as I would like. But I can say this, the market was hesitating and is still hesitating right on in the area. A neckline that would be drawn right on in that area. Continuous caution is therefore still advised. Chicago soybean meal. I wrote some 12 weeks ago, and I quote, "The month of May was a monthly key reversal down. It is important to remember that." End of quote. What I wanted to emphasize at that time and ever since is that everything since May has been in the shadow of that singly bearish pattern. With this in mind, it brings into perspective the breakdown in June. Though the long moving average currently at 392.60 and the drop down to the lower time currently 292.5 of the bearish 2021 Andrews Pitchfork, the subsequent bounce up only ended in the market going sideways throughout July and August, and also running along the underside of the middle time, and that's currently at 338.80. As part of this action, prices created a lower trend line, currently 344.80, and thus the market drew a descending triangle pattern over July and August. In late August, prices punched down through the lower trend line of this descending triangle and finally reached target X in the 337.20 area. This was the original target for the bear flag during May and June. However, when prices dropped down 3 weeks ago, the market must have felt that it was also too far away from the comfort of the middle time and the last weeks since moving back towards it. Thus this week prices have enveloped the middle time once more. In all that time we still have below an initial target X1 for the descending triangle in the 326.10 area, whilst the secondary target X2 would be in the 306.80 area. This is, of course, assumes the current move lower continues to be a genuine move lower, and to be honest, the last 3 weeks sideways action does sow a very small seed of doubt. As a final point, I would like to once again recognize the wonderful job the bearish Andrews Pitchfork for 2021 has done, originally drawn back in May. It is in its overall task of channeling the market lower. It has been useful and valid all up until this very day, and it seems likely for some time hence going forward. That is the key of the market here, and the bearish Andrews Pitchfork, when it finally gets busted or adjusted to a bearish shift pitchfork or some other pattern, then we can look for new ideas. But until then, the bearish incentive is still running and ruling in this market by this same simple bearish Andrews Pitchfork. Simple as that. Chicago soybean oil. For months now I have highlighted the rather lopsided diamond pattern seen over May to July. Looking again today, I still find it to be one of the key patterns here, but it has some other competing patterns now. A few words again on the diamond pattern. Diamond patterns can be tops, bottoms or continuations. In this particular case it is a top. Back in late July the market broke down through the lower trend line but did not immediately follow through lower. Instead the market chose to run along the underside of the broken trend line. This stopped when the market reached the right hand side apex of the diamond. That's at the end of July, thus providing additional bearish pressure to the diamond pattern's breakdown, making it a genuine action. Anyway, prices dropped, but then they came across an obstacle. The medium moving average, currently 61.68, and halted for a while in early February. By the middle of August, prices had overcome this obstacle and continued their journey lower, though the congestion zone between 57.64 and 59.44, which you can see as a striped band across the middle of the daily chart, and punching through the lower trend line, currently at 54.46 of the July to date descending wedge pattern, though not really exploiting the lower trend line. You see, last week prices tried again to move below the lower trend line, but they met another, in this case a pair of obstacles. They are the rising long moving average, currently at 55.58, and the 50% Fibonacci line for the whole of 2021 so far at 55.43. Now we did have 2 consecutive closes below the 50% Fibonacci line, if only just on the second day. However, we did not have a close below the long moving average despite 2 days of breaching. Interestingly, this is the first time the market dipped below the long moving average since July last year. Anyway, prices have moved back up again within the descending wedge pattern over the small new late August based downtrend, currently at 56.86. Now we've moved up within the descending wedge and up through the previously mentioned, and I quote, congestion zone between 57.64 and 59.54, which you can see as a striped band across the middle of the chart. And that's the end of the quote. I've repeated it already. Such that today we are testing the top of that congestion zone, and we've also punched up and out of the descending wedge pattern itself. If we maintain this over today and tomorrow, and don't have a false break, then we would have a significant move back upwards in the offing. Now we could have a potential target X2 in the 66.80 area. This is a big ask, but it does carry the caveat that we still haven't confirmed it as yet. So we are really jumping on the gun for this one. Plus we have two important overhead dynamic resistances that are only now coming back into play. The descending short medium moving average currently at 60.39, and the slowly declining medium moving average currently 61.68. These are the least the market will have to deal with on the upside. Anyway, as an alternate to this new concept, the two targets below for the diamond pattern, the initial target X, that's in the 55.90 area, was achieved then 3 weeks ago. Nice action by the market, by the way, and we still have a secondary target X1 in the 53.80 area. Now, as you no doubt are aware, secondary targets are much harder to achieve, so I'm only holding my breath over achieving target X1 below. Part of the reason for this reluctance and obvious and possible missed target has been mentioned a few times here before. It is the gently rising long moving average, which last week put paid to ideas of a big win. And going the extra bit to reach target X1 would be nice, but not essential. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZE Tofpik and ADM Investor Services International Limited. And here comes the final bit.